I think that what you've seen in the last half of last year and what you're seeing in the first 2 months of this year is the return of the corporate acquisition. Corporate acquirers were about 80% of the market, have been 80% of the market so far this year. We're about 70% of the North American market last year. This is all driven by the need to demonstrate growth and, importantly, the need to show greater margins. Let me back up for a minute and explain this. If we look at some of the work we've done internally on what drives stock price performance and returns, growth is probably, superior growth is probably responsible for about 2 turns on an EBITDA basis for market performance in 2023. But margin improvement is another 2 turns.
So that's synergies. Do you see, come on, there's like 3 major mergers today, including the Barclays at Reorg, which I don't want you to comment on. But the bottom line is they got to cut, Paul, billions here. I mean, they got to cut billions of costs, right?
I think that I haven't seen the numbers yet on the Capital One Discover merger today, but certainly their cost savings and cost synergies, utilizing the platform more aggressively, are an important part of what drives the economics, in particular, of stock transactions, such as, say, the Capital One Discover merger. But the other part of the synergy equation, and it doesn't really get talked about in the announcement, it really doesn't get valued as much by the analysts, but an important part of the synergy equation are revenue and platform synergies. And I think that's one of the things that you will see in some of these large acquisitions, both on the energy side, on the healthcare side. Certainly, I think that'll be an important part of the acquisition that was announced today.
So, Christina, on the Bloomberg terminal, we have a great function, MA Go. And every time I see a trade cross the tape, I go MA Go to see which of my friends on Wall Street are getting paid. Now I don't look at that anymore. Now I look at see who the legal representatives are, because I think they are more important than the bankers today, because I've got some regulators down in Washington, D.C., that I don't think they're very merger friendly. Talk to us about the regulatory environment for getting deals approved. It seems like the regulators are really looking at a lot of deals, a lot of industries.
Sure. I think that obviously this administration's level of enforcement has been more active. They have put forward new merger guidelines for the first time since 2010 that we've seen a change in those merger guidelines. They're certainly more aggressive. They have lower levels of concentration, certainly lower market share targets, and indeed take some novel approaches to enforcement, such as compound acquirers, some aspects of vertical integration. So certainly the DOJ and the FTC have become more vocal and more active. But when we actually look at what's happened over the past year, when these challenges have been taken to court, you've seen the courts react a little differently. You've seen the courts adhering a little more directly to the 2010 level of 2010 guidelines. So I think it's become a little clearer what the cans and cannots do. But certainly, I would always hire a good lawyer if I were doing a deal.
Exactly.
And certainly in this environment, if you're doing the kind of horizontal mergers that are the flavor of the day, you certainly want to make sure that you have the right antitrust counsel.
Well, Capital One's got Wachtell Lipton, and Discover's got Sullivan Cromwell, so 2 pretty good firms right there. So talk to us here about 2024. I mean, are we going to have more activity simply because the market anticipates rates coming down, and maybe some of your clients are going to be a little bit more inclined to be aggressive?
Certainly. I think that, I think there are 3 parts of the merger market, all of which have the prospect for improving in 2024. First, we've talked a little bit about the strategic acquirers. I think that the combination of the increased corporate confidence, the fact that what you're seeing among the strategic acquirers is the real benefits that the larger strategics, in particular those that have like A ratings and above, have in terms of benefit of the cost of capital. They have cheaper costs of capital and the ability to out-earn almost anyone.
To me, that's the heart of the matter. Nassim Taleb says the gravity's returned to the market, including your M&A world. The answer is money was nothing. dire straits. Okay?
Yeah.
Now money costs something. That's going to have us with an M&A frenzy, what I called last year the Great American Roll-Up. Isn't that what we're going to see?
I think we're going to see increased strategic activity. As I said, corporate confidence, cost of capital, those types, and the search for growth and margin improvement. That certainly will continue to drive the strategic dialogue, and I think we see that amongst all of our clients. The second part of the market that is important is the corporate deconsolidations, the spin-offs, for example. Last year, we saw about 400 billion of spin-off transactions, about 25% of the market, certainly more than we've seen on average. And that's being driven by the fact that if you look across America, or across the S&P 500 rather, almost 30% of the multi-divisional companies have divisions that aren't earning their cost of capital. I think that's driving spin-off activity, that's driving corporate divestiture activity. That'll be an important part of what happens this year. And finally, you have the financial sponsor market, which in 2023 was at its lowest level since 2013 at about 535 billion. That market, with rate stability, with improvements in the high yield market, with the 1.5 trillion of cash that's dry powder that's available among the sponsors, that market is set to improve.